Okay, so this video is to share some of my thinking about investing and asset allocation under the negative impact from the COVID-19 pandemic. Okay, so my roadmap includes a quick review of the state of the economy in the age of COVID-19. Then I'm going to discuss quickly the fiscal and monetary policies that have been put in place by the government and the Fed. Then I'm going to talk about the future possible scenarios of the economy and the corresponding asset allocation we should consider in our personal portfolio. And finally, some reminders of the necessary cares to your personal finance. Again, if you have questions, feel free to enter into the chat box so that I can answer at the end of the presentation. Okay, as we speak, this is the data I grabbed today from 1.3 acres website. And the world, we already have 2.6 million confirmed cases of infection of the the coronavirus. And in this country, we have over 858,000 cases. And you can see that around the world, this top line is the US cases, and we are #1. And here, across all states in the US, and here at the top is the New York, the green bar is the New York State cases, we're #1. So we currently live in the epicenter of the pandemic in the whole world, okay? As I mentioned, the stock market has gone through a wild ride, okay? And over the last month also, you can see that the stock market has plunged very quickly down to by about 35%, and there was a strong rebound to by about 20–25%, okay? Over the last 2 months, we have witnessed the circuit breakers of S&P 500 trigger 4 times intraday, which was unseen, right? Mr. Warren Buffett said it took him 80 years to see one time of the circuit breaker to be triggered, and we've seen it 4 times in 2 to 3 weeks. And in the futures market, there were 7 times that the market had experienced either limit up or limit down, which is 5% change in the futures market. So this is being very volatile in the stock market. As you can see, the implied volatility, which is the VIX index, right, has been really high, which exceeds the level in the financial crisis. Okay, if we can recover the VIX index back to 100 years, in the last 100 years, you can see the level of volatility or the fear of investors we have seen is at the top of all episodes, right? Among the top, that's comparable to the 1987 Black Monday, that's comparable to the 1933 market crash. So this has been tremendously volatile and uncertain period in the stock market. And I also mentioned about the Russian-Saudi Arabian oil price war, right? And oil price has plummeted from $60 to $20. And this Monday, we actually have seen one of the futures contracts expiring in May. The oil futures contract has dropped below 0 to -$37 per barrel. So this is unseen and unheard of, right? If you buy something and you actually owe the seller money because you purchased something with your money, right? So this is, again, unprecedented, very bizarre phenomenon, okay? Why this is happening? Because everywhere in this country, we run out of tankers to hold the oil supply that's not used by consumers because everybody is staying at home. Okay? And today we have the news of the 5th week getting into the pandemic, and we have 4.4 million people filed the jobless claim. And this adds together, the 5-week jobless claim adds together exceeds 26 million population, right? So 26 million people have lost their jobs in the last 5 weeks, which you can see is unprecedented as compared to the last, decades. We don't see that fast of job loss in a typical recession for decades and decades. Okay, this accounts, if we consider 163 million of labor force in this country, which is the data based on the early March data of this Bureau of Labors, and we have already 16% of the labor force lost their job in the last 5 weeks. Okay, and if you look at the number 26 million, essentially we have wiped out all the job gains since the Great Recession in 2007. Okay, and for questions, I'll hold it until the end to answer. So sorry about that. Okay, and why we are here, right? Why this is going to be, and this has been very difficult recession, is because we went into the recession very rapidly without adequate preparation at the household level, right? So I'm going to focus on household and individuals instead of corporations in this talk, right? And the household level, you can see the debt level of US household has been in the record, $14 trillion of total household debt, and which accounts for 70 to 75% of the GDP, right? Since the last financial crisis, the mortgage debt didn't grow as much. However, we have a rapid growth in auto loans and student loans, which add to the total debt. So our total debt didn't come down since the financial crisis in 2007, right? And student loans altogether has been the record high, $1.6 trillion of student loans, and we have 45 millions of borrowers of student loans, and the average debt is 33,000, and the default rate at this point is close to 11%, and this is before the pandemic hits. Okay, so you can imagine what's going to happen in the last 5-6 weeks. And also, a lot of Americans have been living paycheck by paycheck, paycheck to paycheck. Why? So according to a latest survey by Bankrate in the late 2019, and their survey shows that 38% of American individuals and households are just trying to stay and getting current on bills, meaning that they don't really put money aside to save, right? It's over 1/3 of the American individuals. And if you look at how much they actually save, 21% nothing, 20% 5% or less, and 28% 6 to 10% saving. And all of them we consider to be inadequate saving because we typically recommend at least you save 15% or if not higher every month towards your savings, emergency fund, and retirement, etc. So people have too much debt, have too little savings, and a lot of them were trying to just get by paycheck to paycheck even before the crisis. Okay, so we were yearly prepared as a nation at the household level, right? So what did the government do, right? This is something really so sudden and so unexpected. And so the government has passed with the fastest speed, right? The fastest speed, and they have passed multiple bills, right? I'm going to talk about those bills. And the first one, the CPRSA Act, they allow free testing, free doctor visits of COVID testing. The second bill, they allow individuals to have the paid sick and family leave, and also they ask the insurance to cover the COVID treatment. The most important one is the CARES Act, which was signed into law on March 27th. It has the direct payment to individuals and families. It has expanded unemployment benefits, and also student loan at the federal level will be freezed. And there's a lot of items to do with retirement withdrawal, loan limits, retirement minimal distribution, etc. Right? And also our guest speaker mentioned about the private lenders. They also offer rent and mortgage payment relief, credit card, vehicle, home loan deferral, which may bring a little bit damage to your credit score, right? If you use those assistance, financial assistance. Okay, so what did the Fed do, right? The Fed has done a lot, right? Very proactively trying to provide liquidity to individuals, families, hospitals, and small businesses and large companies, right? Initially, the Fed cut the interest rate by 50 to 100 basis points, and now essentially our short-term lending rate, the Fed fund rate, is 0, and they cut the reserve requirement ratio for banks to 0. And the second stage, the Fed decided to purchase a lot of assets from commercial papers, provide liquidity to money markets. They have this currency swaps, which gives liquidity to foreign governments. The Fed also started to purchase municipal bonds, corporate bonds, and they said we're going to spend the $700 billion purchase plan to unlimited, right? As long as the economy needs. They also provide a lot of support for lending programs. There's a bunch of lending programs to small businesses, to medium-sized businesses, and also the lending programs that actually provide paycheck to employees that can be partially forgiven, right? So all this program added together, according to the estimates by CNBC, it's over $6 trillion. And today they pass another, so it's not the Fed, it's the Senate passed another bill that's another $500 billion. So all together, those stimulus relief is over $6 trillion, and this is unprecedented, right? So they call this Fed bazooka. So the Fed balance sheet has increased by more than 50%, right? From $4 to $6 trillion, and it's gonna go continue to rise. And the debt from the government is now over 110% of the GDP, okay? So the typical family or individuals, then what's the traditional asset allocation, right? So this is somewhere I bring in my own opinion and thoughts, right? So typically a family would have cash, right? We call emergency fund. And they have home equity they can tap when in a recession or they have lost job, and also they have retirement accounts, and the typical allocation is stocks and bonds, and you put more money into stocks when you're young and more money into bonds when you are older, right? Some other investments of the families include like investment for college funds of the kids. Some family have rental properties, and that becomes a problem because a lot of people stop paying their rents after they lose jobs. Real estate crowdfunding or P2P lending also can be a problem because of real estate. Same thing, people stop paying rents, and P2P lending, also personal lending, and default rate will and has risen, right? And private investments. So what's going to determine the future state of the economy is essentially what's going to to some extent remind us of the ideal asset allocation. So here, we all know that multiple factors will be at play to determine how soon we can get out of the recession and how much we can rebound back to the normal economy and other stuff, right? So the 4 important factors here to consider includes the virus, right? The virus sets the timeline, it's not us, right? And the Fed and policies, which I have mentioned, they have done a lot, and fiscal policies, which is set by Capitol Hill and the government. And lastly, there's another factor which we call the geopolitical tension, including US with other government, especially with China, right? Typically, we would just consider 3 types of scenarios of future economy. Okay, a very good one, a normal one, or a bad one, right? So the very good one will have strong rebounds. In those cases, we have high GDP growth and reasonable inflation. So you want to hold stocks, maybe commodity because production comes back to normal. For a good economy, which is okay economy, and the GDP growth will be slow, but we slowly recover from the recession, and you can hold stocks, you can hold bonds. And for bad, relatively bad scenario, we may have prolonged recession until we find a cure or we find an effective vaccine, right? So that may correspond to negative growth for multiple quarters, but only slightly negative, right? So in this case, you do want to have cash and treasury bills and just to provide that margin of safety. Right? However, I think in this particular episode, right, we have seen such a profound crisis that GDP growth, some of the bankers are estimating could be negative 20%, negative 40% in Q2, right? So we have to consider something a little bit atypical, right? For instance, what if this recession is a longer one, it's a bad one, we enter into a period of stagnation, which means we don't have growth, but we actually have inflation. So that's entirely possible, like in the 70s, because we have the disruption to the supply chain, we have the geopolitical tension, which will cause problem in international trades, and which has. And so what kind of assets should we consider holding in that scenario, right? So I would say in that scenario, maybe gold will outperform, maybe commodity, real assets will outperform, and stocks I'm not 100% sure because you may have stocks outperform nominally, but if you look at the real purchasing power, it's not outperforming. The worst scenario, which I still think we should consider, which is unlikely, but is still a possibility, is what if we enter into a depression, which is a multi-year long recession, like the 20s and 1930s in this country. We have this bankruptcy, large-scale bankruptcy and deflation, which is the worst among all, right? So what assets should we consider? I really don't have a good answer here. Maybe gold, but gold actually underperforming in the 30s. Maybe real assets, I'm not sure. But I know that stocks are not gonna do well. I checked it in the 1930s, stocks underperform. You hold stocks for 10 years, you're not going anywhere. It's zero or negative, right? Cash, maybe cash is fine. I'm not sure. I think cash will work, but it depends on whether the currency would stay stable, right? Definitely, you don't want to have junk bonds because many of the bad quality company will go bankrupt in those scenarios. So overall, I would say my thought is because we're not out of the woods yet, because this crisis can be fast or can be long, we don't set the agenda, right? The virus sets the agenda, and there's many complications, multiple factors that are at play here. I would say the best and prudent approach is to build a well-diversified portfolio, that you have assets that would perform in any possible state of the world, okay? And you want to follow the advice to rebalance your portfolio in order to improve your returns in the long term. You don't want to freeze. You want to have a plan, and write down your plan, and follow it through and adjust your plan according to the new information. Right. As we speak, I also checked the performance of those asset classes from the beginning of the year, right? So those are the charts from January the 1st all the way 2nd to all the way to yesterday. You can see that this is recession. We're in a recession. So what's outperforming, right? This year, it's treasury bonds, it's gold, and cash. Okay, it's, you get zero interest, but you know, people rush to cash. Actually, cash is now trading at a premium, right? Money market funds. And corporate bonds, it had its dip, and because Fed was purchasing corporate bonds, so it recovered. And the stock market, NASDAQ, has outperformed SP, but it's underperforming cash. SP underperformed NASDAQ. The worst performing our assets is commodity. Okay, why? Because there's no production. We don't need commodity and to produce goods. And so that's why commodity is being underperforming this year, right? So in addition to maintaining and preparing for future states of the economy with a well-balanced, well-diversified portfolio, and some reminder of, I think, more fundamental aspects of personal finance, right? So as we discussed, that for some people, if your job is not secure, you really want to prepare with a large emergency fund, right? It's not 3 to 12 months. For some people, it should be 6 to 12. It's not 3 to 6 months. So for some people, it should be 6 to 12 months of living expenditures, right? And you can hold the living expenditure maybe mostly in cash, a little bit in gold, in my opinion, a little bit in treasury bonds, because those provide hedges in different states of the world. And second, I think all families and individuals, especially if you have a family, you have kids, and you want to have your insurances in place, right? So this includes not only the health insurance, but also we call last will, living will, power of attorney, term life insurance. And this is the time to get everything ready so that you take care of your personal finance, right? Those are the must-have for everybody. Now you need it more than ever, right? And the third one is, for everyone, I think we need to consider how to develop multiple sources of income. For many people, okay, so 75% Americans are going to see or have seen their income will be cut by 25%. So most people will lose a portion of their income. So where to find another source of income to make up for the lost income, to actually strengthen your financial health of the family, it becomes very important. So this is the time to adapt yourself to become entrepreneurial, right? And also, I would say don't count on your pensions and Social Security. If this crisis deepens and prolongs, we're not sure whether pensions will be there and Social Security will be there. It will be there, but I don't know what will be the state of those safety nets at the time you need it. Okay, lastly, I want to stress what I meant by gold. Although I said gold, I meant precious metal. I meant something that's not cash, not US dollars, not stock and bonds. Those assets include gold miner stocks, precious metals such as silver miners, and also even Bitcoin. I would consider Bitcoin as a digital gold, okay? Although it has the risk of becoming zero or outlawed by the government, but getting off zero with Bitcoin, hold something like a 1%, no more than 3% of your net worth or investing portfolio in Bitcoin, and can potentially provide some hedges. but it's very volatile. You have to be able to stand for the volatility. It's like 25% drop is normal in that on that market. Okay, so lastly, here are my references that I recommend you to follow. Ray Dalio's articles from LinkedIn and JP Morgan, Vanguard, Goldman Sachs economic outlook handbooks, and you can download and you can read them for free online. And also podcasts I've been stressing over the semester, like Macro Voices, Real Vision, the Pump podcast, the Financial Samurai. Those are very helpful and they provide different aspects. So make sure you read a lot and hear a lot so you get all kinds of perspectives so you can think and conclude through your own analysis. I also recommend the YouTube channel Around the World with Fiscal and also the Chevelco Capital. I think they're very helpful for me as well. Okay, so the information here is for your information, not individualized financial advice, and I don't take responsibility for any information, the consequence of using the information here.